The Canadian Agri-Food Policy Institute is driving bold policy solutions for a resilient Canadian agri-food system and building a stronger future for Canadian agriculture. Visit capi-icpa.com to discover how.
Okay, let's talk markets. Joining us right now for this segment is Ed Broschinski, who is with Cargill. How are we doing today, Ed?
I'm doing good, Sean.
Good. You can you believe we're at the end of November here?
No, not really. It's snuck up on us pretty quickly here. Yeah.
No kidding. Okay, there's lots happening in the markets. Let's start a little bit broader, 100,000 foot. Provide some perspective because one of the things that's really noisy and cloudy right now is there's just so many headlines like this, and this, and every day it's something that's kind of potentially moving or not moving the market. What's your thoughts on where we are here at the end of November?
Well, at Market Sense here, we've kind of coined this term called a foundational market. That's what it feels like we're in right now. And you hear about bull markets. You hear about bear markets, and a lot of people say, well, in between, you've got a neutral market or a sideways market. And I think that the price action feels anything but neutral or sideways. And I would characterize it as a foundational market, which pivots around the cost of production. So you have periods of time where the market trades well below the cost of production for farmers for a number of reasons. I'll pick a headline that you could point to a reason why, but when it's below the cost of production, that generates demand. And we've seen, for example, in wheat, record demand, right? On the flip side, it sometimes goes above the cost of production where farmers are making a profit. You might point to canola in that scenario right now. And that brings supply back onto the market, right? And we're pivoting on either side of that cost of production. That builds a foundation of supply and demand that is not a trending market. It's not bullish. It's not bearish, but it's really part of the necessary cycle before we move on to the next stage of the market cycle.
How often do we have this stage of the cycle, what you would define as a foundational market? Is this something that comes every couple of years, like the cattle cycle 7 years? How about this?
I think that it's hard to say exactly how long it lasts or how often it comes along. I think the last time we were in a foundational market was really a long period of time between 2014 and 2020. So almost 6 years that the previous foundational market cycle lasted. We formed a really solid base of demand, and that allowed the bull market that occurred in the early 2020s to occur. So that's a long time. I'm not saying that this foundational cycle will last that long, but it can be a long time.
Can it be good for growers?
Well, I think it's good for growers in that it generates some market stability, or at least some understanding of what normal is. Again, there's definitely volatility within that cycle, but that stability attracts demand, attracts confidence in the price ranges, and that at the end of the day, what we all want is stability of income, right? That's kind of the goal.
Okay, so what if I'm holding inventory, I've got some 25 crop around me, I'm making my plannings for 26. If it is a foundational market, what does that mean for me in my business planning and my marketing plans?
Well, the first thing is to make sure that you understand your own cost of production as a farmer, where when I say that the market's trading on either side of the cost of production, I say that's the average. Now, every farmer is going to be different than the average. And so it's really important, especially if you're one of the higher cost of production, higher overhead farmers, that you're taking advantage of the times that the market's trading near the high end of the foundational range, because it tends to be with big crops and big demand that the high end of the range doesn't last long because those big crops get sold into the market. And it always feels like, from a headline perspective, that we're just on the cusp of a new bull and it's going to break out and it's going to go to the moon, right? It always feels like that. And then, of course, some other headline comes along and breaks it back down. So we've got to take advantage of it.
Canadian farmers right now, if you look at our October results of the Canadian Farmer Sentiment Index, they're holding. They see market, this is a time to hold. The market will have some lift into the future. That's their anticipation. It was a 135 at a 200. Okay, so we're up considerably since July.
Mm-hmm.
Is there reason to be optimistic about the future direction of prices here, given what you're seeing in some of these fundamentals?
I think that the fundamentals are are pretty heavy right now for a lot of the crops. So you're seeing, record corn production in the United States. It might be a record canola crop here in Canada, a really big wheat crop globally, a massive wheat crop. So the fundamentals are actually kind of heavy. And so I don't see a fundamental reason for the market to rally. There is, however, a sentiment reason, right? We're seeing the headlines from China, Donald Trump, pushing the trade deal. We're seeing biofuel sentiment, for instance, in the oilseed market really, attract a lot of attention, bullish attention. So there's sentiment reasons why the market could go higher, but fundamentally, it's a time to be taking risk off, in my opinion.
When I hear you say there's sentiment reasons, that doesn't lead me to like sustained rally. That maybe there's opportunistic times or points or number of days, or maybe it's an afternoon in the market, but that doesn't sound very sustained. Is that a fair assumption by my?
Very, very fair assumption. That is a defining characteristic of a foundational market, is that you get these opportunistic rallies that are really exciting, and those are the opportunities that we have to take advantage of, even though in the moment it's sometimes hard to believe that the price might start to back off.
I just want to leap back a second, because I have a section of my audience they heard you say, Ed, you need to know your cost of production. What I hear from the audience from some people very adamantly, the market doesn't care what my cost of production is. The market is the market. So know it, but it doesn't necessarily impact my marketing strategy, because I'm looking at the pricing action and the fundamentals of supply and demand, not my COP. I want to circle back on that so you can explain what your point is.
So I disagree with that in part. I agree that on any given day, the market doesn't care about any single farmer's cost of production. But in the, say, medium run, the market does very much care about the average cost of production. And what you'll find is that markets do go down and find support at those average cost of production levels. We did see it in the wheat market this year. It went down to the average cost of production for wheat in Canada. It went a bit below it as harvest pressure came and dumped some, wheat went on sale, you could say. But it didn't go a lot below it. Farmers selling shut off in aggregate around those levels. So the market does respect average cost of production. As an individual farmer, though, nobody's paying attention to that number. And that's the only person paying attention to that is you as a farmer.
Yeah. Make some sense of oilseeds for me. Soybeans, nice little rally after the announcement of, what could potentially happen from a U.S. export perspective to China, 12 million metric tons before the end of the year. There's a lot of work to be done. I think they're like 9 million metric tons still short. And then there's 25 for the next 3 years, each year. But we haven't seen canola. Canola's kind of been more of a sideways trade, I guess. What's happening in the oilseeds here?
Well, right now the oilseed is very much, or especially soybeans, very much sentiment driven, right? There's a lot of this expectations that China's going to come in with the big buy side orders and drive futures higher, drive basis higher. We've seen a lot of that move already, in my opinion, because what the market might be not paying attention to or trying to ignore is that U.S. beans have now become fairly expensive on the global market, and there may be demand that's being lost, non-China demand being lost to cheaper suppliers such as Brazil now. So I think the question becomes is, if you're trading a Chinese bushel of beans of demand, but you're losing a European bushel of bean demand, are we really getting anywhere, or are we just spinning our tires in the overall aggregate demand? So I think the market's starting to get a little bit hesitant on the bean side. Canola is trading sideways because, one thing, there is a lot of optimism about the future of biofuels. And so that's supporting soybean oil, and that then comes in and supports canola. At the same time, really big crop in Canada this year.
Yep.
We'll see what StatsCan says on December 4th, but that supply is also hanging over the market.
Do you have any clarity or insight here? Of course, we talk a lot about the tariffs that China has on Canadian canola oil, seed, and meal. Are they still buying? Have any cargoes gone to China, or give us an update? Because a lot of times we talk about this as if nothing is going to China. I have a hard time believing that. What insight do you have?
Well, There is a couple of cargoes that traded into China earlier this season, right in the fall time. Those cargoes that show up on the shipping lineups, they go to a free trade port in, oh geez, and I can't remember the name. It's Henan, I think.
Okay.
Don't quote me on it, but there's a free trade port in China that is typically tariff free. It's kind of an experiment that the Chinese have been running for several years. The condition on that plant can buy Canadian canola only on the condition that it sells the oil and the meal outside of China. The oil and the meal is not allowed into China. So there's a very limited amount of demand, but it does show up on the shipping lineups as a China sale. I think the market's, a little bit encouraged by that. But so far we haven't heard any kind of meaningful demand out of China. They've just been completely quiet there.
Okay, so what's the substitute? They either just don't need any, or because I've even heard that Australia hasn't exactly been a rocket ship to the moon in terms of how much they've been pulling out of there. It's been a little bit slow as well. So, do they need canola? Have they just been using South American beans from that perspective, or what's going on here?
That's been a big surprise. One of the things that we thought would happen was that China would come in, buy Aussie seed. Aussie seed would get much more expensive as a result, and we would basically sell all our canola to everybody that the Aussies used to sell it to. That hasn't exactly happened. The Aussies are actually cheaper than Canadian canola right now. Why is that? Well, when you look at aggregate Chinese oilseed imports, they are up year over year, and most of it's up in beans. They've also been buying palm oil. They've been buying other oil seeds. The other side of the equation is Chinese oil demand, vegetable oil demand has been relatively weak. They are now the third largest exporter of soybean oil to India. And so it's clear that the Chinese veg oil demand is not as strong as it once was. And that might be part of the reason they just don't need as much oil seeds, or rather oil heavy seeds like canola this year from anybody.
Yeah, well, which affords them the ability to implement the tariff plan that they are, because if you don't need it, you don't care what the tariff is.
Yeah, that's right. It allows them to have optionality and pick and choose when and who they buy from and at what price.
Yeah. Before we wrap up here, Ed, one of the real demand stories has been U.S. corn exports. Is that something that can be sustained here through the winter months?
I think that if soybeans aren't being exported, then you can sustain the corn export pace. If you do have a resurgence in the U.S. soybean export program where China's coming in buying 12 million tons and you've got good demand from elsewhere as well, then it's going to compete with corn capacity, and it'll be hard to sustain the just absolutely phenomenal pace that we've seen. I think it's up over 70% year over year. And that really is just a function of not having to compete with beans for space.
It's been torrid. There was somebody had a story out with this very concern that, for corn to stay on this pace, and if China's going to buy the 25 million metric tons in the 26 year, it's gonna be hard to do both. Like there's like a capacity issue there at some point. Hey, Ed, really do appreciate you joining us here. If somebody wants more information on Cargill Market Sense, how do they find you?
Well, you can definitely find information about Cargill Market Sense on the Cargill website. The best thing to do, though, if you want to get connected with a Market Sense advisor, is just to phone your local Cargill location. The advisor might pick up the phone there, but definitely somebody will be able to put you in touch with somebody who can help you make a marketing decision if you need to make one today.
And Lord knows in this market, we do all need help, all of us. Okay, Ed, thanks so much for joining us. I appreciate it.
Absolutely. Thank you, Sean.